Is VICI Properties a buy right now? It is yielding 6.7%. It is sitting at its lowest valuation multiple in over 5 years. Vegas tourism is slipping. Interest rate expectations just shifted dramatically in a direction nobody was expecting at the start of this year. There's a real case on both sides of this trade, and today we are building both of them from the ground up. The bull case, the bear case, the valuation models, the fundamentals, and the dividend sustainability. So that by the end of this video you have everything you need to make an informed decision for yourself. No hype, no fear, just the data. Let us get into it. Welcome back to the Dividend Desk, where we build income strategies for real life. If you are new here, this channel is built around one core belief, that the best investment decisions are not made on emotion, on headlines, or on what the market did yesterday. They are made by understanding what a business is actually worth, whether the income it generates is sustainable, and whether the price you are paying today gives you a reasonable margin of safety for the future. And VICI Properties right now is one of the most interesting and most debated names in the entire REIT space. So before we go any further, this content is for educational and informational purposes only. It is not financial advice. All investments carry risk, including the potential loss of your capital. Past performance does not guarantee future results. Please consult a qualified financial professional before making any investment decisions. Let us start with what is actually happening with the stock price, because the numbers here are genuinely striking. VICI Properties has fallen substantially in just the last few months. Over the last 6 months, the rate is down approximately 17%. And in just the last month alone, it has sold off by nearly 10%. To put that in context, this month's sell-off is the largest single monthly decline VICI has seen since December of 2024, when it dropped over 10%. And if you exclude that December move, this is the largest monthly sell-off since March of 2020, the pandemic crash. So we are talking about a move that by historical standards for this specific stock is genuinely severe. The result of that sell-off is that VICI is now trading at its lowest valuation in over 5 years, with a price to adjusted funds from operations per share multiple of just 10.87. To understand why that matters, the average price to AFO multiple for VICI over the last 5 years has been approximately 14.4. So we are sitting more than 25% below the historical average valuation on that metric alone. And at current prices, the starting dividend yield is sitting at approximately 6.7%, which for a REIT of this quality is a genuinely elevated starting point. Now, before we get into whether this is an opportunity or a warning sign, we need to understand what VICI Properties actually is and why it has historically been considered one of the higher quality names in the entire REIT universe. VICI is a triple net lease REIT, meaning they own the real estate and lease it to tenants on long-term contracts where the tenants themselves are responsible for maintenance, taxes, and insurance. This structure creates significantly more predictable and stable cash flows than a traditional landlord arrangement because VICI's expenses are much more controlled. Right now, VICI is sitting at 100% occupancy across its entire portfolio. Every single property it owns is leased and generating rent. And historically, VICI has maintained essentially 100% rent collection, even during 2020 when the pandemic forced physical closures of many of their properties. That kind of rent collection consistency during a once-in-a-generation economic shock is genuinely remarkable for any REIT, let alone one with this level of concentration in a single market. And that brings us to the core of both the bull and the bear case for VICI right now, the concentration issue. If you look at their investor presentation, the tenant concentration picture is very clear. The vast majority of the rent VICI collects comes from Las Vegas tenants. The top 3 tenants are all Las Vegas-based, and together they account for over 80% of VICI's total rental income. For years, this concentration was considered a feature rather than a bug, because Las Vegas was on one of the longest and most powerful secular growth runs in its history. The Raiders, the Golden Knights Stanley Cup champions, the WNBA Aces, Formula One racing, the 2028 NCAA Final Four, a brand new home for the Athletics. Las Vegas had transformed itself from a gambling destination into a genuine all-season entertainment and sports capital, and VICI owned the real estate that sat at the center of all of it. But the data coming out of Las Vegas recently has introduced a new and uncomfortable question. What if the tourism trend is starting to reverse. In 2025, total visitor numbers to Las Vegas were down 7.5% for the full year. December specifically saw a decline of 9.2% compared to the prior year. And, as we have moved into 2026, the trend has continued. January 2026 saw total visitors down, relative to January 2025. Hotel occupancy was down. Gaming revenue fell by approximately 8.4%. These are not catastrophic numbers, but they are consistent, and they are directional, and for a REIT with over 80% of its income concentrated in a single market that is declining in visitor volume, even a slow and gradual trend in the wrong direction is something that deserves serious attention. Now here is where it gets more nuanced, and where I think a lot of the market commentary on VICI misses important context. When you look at the hotel metrics more carefully, the picture is not as bleak as the raw visitor numbers suggest. Yes, occupancy was down 2.4% in January, but the average daily rate, essentially the average price per hotel room per night, was up 6.7%. And when you combine those two figures into the single most important hotel performance metric, which is revenue per available room, that number was actually up 3.5%. Fewer guests, more money per room, net positive on the revenue side. This is a meaningful data point because it suggests that while Vegas may be seeing fewer total visitors, the visitors who are coming are spending more. The quality of the tourist is holding up even if the quantity is declining. For VC investors, this is a significant sigh of relief, but it is not a full all clear. The overall trend of fewer people visiting Vegas is real and it needs to be watched, but here is the thing, and this is crucial to understand about the triple net lease structure. In the short term, declining Las Vegas tourism does not directly impact VC's income at all. VC collects rent. The tenants pay that rent regardless of how their monthly visitor numbers look. The risk only becomes material if tourism declines so severely and for so sustained a period that the tenants themselves begin to struggle to make rent payments. We are nowhere near that scenario right now. The tenants are large, well-capitalized casino and hospitality operators. They have the financial strength to absorb short-term tourism softness without it threatening their lease obligations to VC. So the Las Vegas tourism concern is real, but it is a long-term risk to monitor, not an immediate threat to cash flows. So if the fundamentals are broadly intact, why has VC sold off so dramatically, especially in the last month? The answer lies primarily not inside VC's business at all, but in the broader interest rate environment and how dramatically expectations have shifted in a very short period of time. REITs as an asset class are acutely sensitive to interest rate expectations. The reason is simple. Are income-producing assets. Investors buy them primarily for their dividend yield. When risk-free rates are high or expected to stay high, the relative attractiveness of a 6.7% rate yield declines because investors can get meaningful yield from safer assets like treasuries and money market funds. When rates are declining or expected to decline, REIT yields become much more attractive on a relative basis, and capital flows back into the sector. Coming into 2026, the broad expectation was that the Federal Reserve would cut rates 2 or even 3 times during the year. That expectation was a meaningful tailwind for REIT investors, and it helped VICI rally from around $28 per share at the start of the year to nearly $30. Then those expectations shifted fast. The Fed did not cut rates at the beginning of the year, and if you look at the target rate probabilities for the next Fed meeting, there is now approximately a 97.4% probability that rates stay exactly where they are. What is even more striking is that the remaining probability is not split between a cut and a hold. It is actually pointing toward a slight potential increase. The odds of that happening are very low at around 2.6%, but the fact that a rate hike is even being discussed as a possibility represents a dramatic and rapid shift from where sentiment was just a few months ago. That shift in rate expectations is the single biggest driver of VICI's recent sell-off, and it explains why the stock has moved so sharply even as the underlying business fundamentals have not meaningfully deteriorated. Now let us look at the fundamentals directly, because understanding the revenue and earnings picture for a REIT requires a slightly different framework than a typical stock. Revenue for VICI has grown substantially in recent years, But raw revenue growth does not tell the complete story for REITs because much of that growth comes from acquisitions funded by share issuance. REITs by nature dilute their shareholders to raise capital. That is not inherently bad. If the acquisitions are accretive, they drive per share growth, but it means you need to look at per share metrics to understand whether the business is actually creating value for existing shareholders. The metric that matters most for REITs is adjusted funds from operations per share, AFO per share. This is the REIT equivalent of earnings per share or free cash flow per share for a regular stock. If AFO per share is growing, intrinsic value is growing. If it is growing, the dividend can grow with it. For VICI, the AFO per share picture is genuinely strong. Over the last 3, 5, and 7-year periods, AFO per share has grown at a very healthy rate by REIT standards, and forward projections are showing continued growth in the mid-single-digit range for the next 3 years. The AFO payout ratio, essentially the dividend coverage ratio, is sitting at approximately 74 to 75% for both 2025 and 2026. That is healthy. That is sustainable. There is meaningful room between what VICI earns and what it pays out as dividends, which means the dividend is well covered and has room to continue growing even if growth moderates somewhat from historical levels. And the dividend growth history here is worth pausing on for a moment because it is genuinely impressive. VICI has grown its dividend from approximately 28.7 cents per share back in 2018 to around 45 cents per share today. That is consistent growth over a period that included a pandemic, a historic interest rate hiking cycle, and multiple economic shocks. The dividend did not get cut, it did not pause, it grew, and VICI has another structural protection built into their leases that many investors overlook: CPI escalation clauses. As inflation rises, the rent VICI collects from their tenants rises with it. By 2035, 90% of their rent roll is expected to have this CPI protection built in. In an inflationary environment, that is a powerful structural advantage. The balance sheet is also worth addressing because any analysis of a highly leveraged asset class like REITs has to include a serious look at debt structure and maturity profile. VICI's net leverage ratio is currently sitting at 5.0 times, which is at the low end of their stated target range of 5 to 5.5 times. That is a healthy position. But what is especially relevant given the current rate environment is that 99% of VICI's debt is fixed rate. That means even if rates stay elevated or edge higher from here, VICI is not going to see its interest expense increase materially. The variable rate risk that is crushing some other leveraged companies right now simply does not apply here in the same way. On top of that, their debt has a weighted average maturity of 6 years, and it is well laddered across multiple maturities, meaning they are not facing a massive refinancing cliff where a huge chunk of debt comes due all at once into a potentially unfavorable rate environment. Now let us run the valuation. The most straightforward starting point is the dividend discount model. If we assume 0% dividend growth going forward, the most conservative possible scenario, VICI would be worth approximately $20.76 per share, which is about 23% below where it is currently trading. So even in the zero growth case, the market is pricing in some level of future dividend growth. And given everything we have laid out about the AFO payout ratio, the per share growth trajectory, and the CPI protected lease structure, that seems like a very reasonable expectation for the market to hold. If we assume a more realistic 3% annual dividend growth rate, meaningfully slower than VICI's historical growth rate, the dividend discount model puts fair value at approximately $33 to $35 per share, implying roughly 22% upside from current prices. But there is another way to think about total return potential for VICI at current prices that I find particularly compelling. It comes down to 3 components: starting dividend yield, AFO per share growth, and valuation multiple change. Starting yield is approximately 6.58%. Add in mid-single-digit AFO per share growth of around 3% and you are already at expected annual returns of approximately 9.58% before any multiple expansion whatsoever. That is attractive. That is a solid expected return even in the scenario where the market never re-rates VICI back toward its historical average valuation multiple. Now consider what happens if the valuation multiple does mean revert even partially back toward that 14.4 average from its current 10.87. At that point, you are looking at total returns that could be genuinely outsized over a 2 to 4 year horizon. So where does this leave us? VICI Properties has real risks that deserve honest acknowledgement. The Las Vegas tourism softness is a trend worth monitoring closely. The interest rate environment is more uncertain than it was 3 months ago, and that uncertainty is not going away overnight. The valuation multiple compression that the stock has experienced reflects genuine concern from the market, and it would be intellectually dishonest to dismiss those concerns entirely. But when you look at the actual fundamentals, the 100% occupancy, the 100% rent collection history, the healthy AFO payout ratio, the dividend growth track record, the CPI-protected lease structure, the fixed-rate debt, the well-laddered balance sheet, and the forward AFO per-share growth projections, the business itself is not broken. Not even close. What we have here is a high-quality REIT being priced at a 5-year low valuation because of external macro pressures that have nothing to do with how well this specific company actually operates. And, in investing, those are often the most interesting moments to pay close attention. Whether VICI belongs in your portfolio depends entirely on your income goals, your time horizon, your existing rate exposure, and your comfort level with the concentration risk in Las Vegas. But at 6.7% yield, at a price to AFO multiple sitting 25% below its historical average, with a dividend that is well covered and has room to grow. The case for patient long-term dividend investors is not hard to make. Drop a comment below telling us whether you are buying, holding, or staying on the sidelines with VICI right now. We read every single one. Hit the like button if this breakdown was useful and subscribe so you do not miss our next deep dive. We will see you at the next one.